Tesla is the most famous electric vehicle manufacturer in the world right now. But recently, the company's stocks have been dropping. In this video, we explore why Tesla's stock is dropping recently. But before we begin, don't forget to give us a thumbs up, subscribe to our channel, and press the bell icon for notifications. Why Tesla matters. Tesla is one of the world's biggest companies producing electric cars and clean energy products. The corporation is based in Palo Alto, California, USA. Tesla's latest offerings include electric vehicles, home-to-grid-scale battery energy storage, solar panels and solar roof tiles, and other such products and services. With a market share of 16% in the plug-in category, which involves hybrids, and 23% in the battery electric, purely electric segment in 2020 shipments, Tesla is the world's best-selling plug-in and battery electric passenger car maker. Tesla designs and installs solar photovoltaic systems in the United States through its subsidiary SolarCity. With 3 GWh of battery storage delivered in 2020, Tesla is now one of the leading global manufacturers of battery energy storage devices. Stocks dropping. Tesla had a fantastic year in 2020. Despite the COVID-19 pandemic, Tesla delivered 36% more cars in 2019 than it did in 2018. It introduced exciting model updates and technology, as well as getting its financial house sufficiently in order to be included in the S&P 500. Tesla stock rose over 700% as a result of all this, indicating that investors were ecstatic. However, Tesla is off to a shaky launch in 2021. Tesla stock has been on a downward trend after reaching a high of $900 per share in January. And as Tesla announced its first annual profit and a 28% growth in sales for 2020, its best ever financial performance, investors were unimpressed. Tesla's stock price fell to $547 on March 8th, a 5-month low. So has Tesla's group come to an end? We have no way of knowing for sure, but even so, it'll be fascinating to learn more about why investors are selling Tesla. Why the stocks are dropping. Market investors, in my view, powered up the price of Tesla stock in 2020 as they thought they could get S&P 500 index revenue to cover whatever price. The index funds were pressured to purchase more the higher they drove the interest. They discovered the real greater fool in this, a customer who would not only purchase at any amount, but would buy proportionally more when the price rose. Tesla was officially admitted to the S&P 500 on December 21st for almost twice the amount it had been trading at only a few months before. The price started to grow as index funds started to purchase in the necessary quantities, peaking in late January amid rumors that Tesla would participate in Bitcoin. Over $80 billion in Tesla shares was forced into index funds, making it the biggest single contribution to the S&P 500 index in history. Market analysts quickly drew comparisons to Yahoo's inclusion in the S&P 500 index in December 1999. When the index was forced to purchase Yahoo stock at significantly higher rates than were normal due to the same scenario, it was one of the largest single-stock asset transactions in history. Hedge funds pushed up the price of Yahoo in 1999 in expectation of its inclusion in the S&P 500. Yahoo's stock price had fallen a year back, and Wall Street was laughing all the way to the safe. For the index front-running, the year 2000 will be the most expensive ever for the S&P 500. At their annual shareholder meeting in 1999, Charlie Munger and Warren Buffett discussed this problem. Buffett's views were foresighted, as mutual funds currently account for almost half of the financial sector share in the United States. Since a shift in market fundamentals cannot easily justify the switch in Tesla stock, chicanery is the most possible explanation. When the popularity of index funds grows and more people conclude that financial results are meaningless, this creates a challenge for the general population as well as an advantage for wise and patient investors. Caught up in the tech sell-off. Due to a wider market rotation from high-growth stocks to bargain stocks, much of 2020's hottest tech stocks are down this year. Peloton Interactive and Zoom Video Communications are traded at least 30% off their all-time peak, while reopening stocks like Boeing and Lyft have gained more than 20% this year. Tesla, like the rest of the industrial stocks, has suffered as a result of its association with the most common tech stocks. However, given that Tesla is one of the most costly stocks on the market, this is unsurprising. Tesla was trading at 25 times 2020 sales at its highest market capitalization of $837 billion. Tesla trades at 20 times sales well after the latest correction. General Motors, America's largest car maker by price, trades for less than 1 times revenue. In other terms, Tesla stock continues to trade at exorbitant prices. Tesla could fall much further from here if investors want to run to protection and value stocks. Bulls acknowledge competition. Some of Tesla's most ardent supporters have sold a portion of their stock and are finally acknowledging the onslaught of electric car rivalry as a genuine threat to the business. Ron Barron, for example, sold 1.7 million Tesla stocks and invested in two of the company's largest possible competitors, Amazon-backed Rivian and GM-owned Cruise, thus paradoxically predicting that Tesla shares would potentially grow to $2,000. Although former Tesla board member Steve Wesley remains optimistic, he said on CNBC's Power Lunch this week that Tesla is not going to be the king of the hill in electric forever. They're seeing competition from all sectors, he said. To compete, they'll have to put in twice the effort. Indeed, manufacturers such as Volkswagen and Ford have seen early traction in the United States and Europe with sales of their hybrid vehicles such as the Mach-E and ID.3. Meanwhile, upcoming electric vehicles such as Ford's all-electric F-150, the Lucid Air, Rivian's electric SUVs and vans, and others are generating interest. Porsche has unveiled the production edition of its Taycan Cross Turismo and announced that sales would begin in the United States this summer. It's a $90,000 EV wagon that's a less expensive, more functional version of Porsche's value EV, the Taycan. Tesla's expansion. Tesla has significantly increased its production capability. Musk plans to produce 20 million electric cars a year by the end of the decade, which is more than twice the average output of other automakers. So the company is already on a quest to quickly increase its manufacturing capability. Tesla has taken a significant move forward with the building of its third manufacturing plant outside Berlin. The factory where the Model Y will be made is expected to be completed in March 2021. Tesla is planning to develop a fourth factory in Austin, Texas. The plant, which will be constructed on a 2,000-acre plot of property, will be Tesla's first. It would make the Cybertruck, as well as the Model 3 and Model Y, as well as the big rig bus, the Semi. Tesla recently announced that deliveries of the Cybertruck would not begin until early 2022, a year longer than the company's original plan of late 2021. Tesla has a buy recommendation and a price tag of $775 according to Mizuho analyst Vijay Rakesh. As it ramps demand globally, TSLA remains on course to meet its long-term unit growth goal of a compound annual rate of 50%, Rakesh wrote in a note to investors. Tesla's competitors are growing. As Tesla begins producing cars in Germany, it'll compete in the electric vehicle market with three well-known German brands: Volkswagen Group, VW AGY, BMW, BMW YY, and Daimler AG's Mercedes-Benz subsidiary, DDAIF. It would be a difficult fight since all three automakers are known for producing high-quality vehicles. Ford Motors' F Mustang Mach-E, Tata Motors' TATA Jaguar Units I-Pace, and the Audi e-tron are all serious competitors. Volkswagen is the company that owns Audi. The Taycan is also available from Volkswagen's Porsche division. Tesla is still up to stiff rivalry in China. XPeng Motors, XPEV, sponsored by e-commerce company Alibaba, is a competitor in China, BABA. NIO, NIO, and Li Auto, LI, are two other rivals. Sales of electric vehicles are projected to increase by 40% to 1.8 million units in 2021 and to 6 million units by 2025. Tesla recently earned $5 billion in its third equity sale of the year as it increases production capability in Shanghai to begin selling the Model Y crossover. What is Tesla's next step? Tesla aspires to be more than just an electric vehicle manufacturer with creative genius Elon Musk at the helm. Tesla is at the forefront of self-driving vehicle growth, offering it a chance to become a robo-taxi business. Tesla's clean energy sector is also growing, with the firm now collaborating with Apple on a battery storage initiative. Both of these prospects in the long term greatly expand Tesla's addressable market outside EV manufacturing. However, Tesla's exorbitant pricing has already factored in these benefits, leaving no room for error. Tesla stock is in for a tough trip if the software sell-off continues. And that's why Tesla stocks are dropping. What do you think about the situation? Do let us know in the comments section down below. And before you go, give us a thumbs up, subscribe to our channel, and press the bell icon to never miss out on our videos.